Is it happening or is it not happening? That's the question everyone keeps asking. And if you're watching the screens the way I am, you can feel the tension building by the hour. One minute it looks like the entire thing is collapsing in real time. The next minute there's a sudden shift and the market snaps back like nothing happened. I told you this was coming. Before the week even kicked off, I said get ready because the volatility is going to be aggressive. It's going to feel emotional and it's going to test people. You are going to see headlines that make it look like the deal is dead. You are going to see statements that sound final and you are going to think that's it, it's over. But this is how negotiations at this level work. This is brinkmanship. This is high stakes positioning. It's the political version of a game of chicken, where both sides accelerate toward the edge and wait to see who flinches first. What you're watching isn't chaos without direction, it's pressure being applied strategically. There are calculated leaks, there are carefully worded comments designed to move sentiment. When one side wants leverage, they let something slip that rattles markets. When the other side wants to regain control, they float optimism. That's why you're seeing the hard sell-offs followed by sharp rebounds out of nowhere. The market gets punched, sentiment cracks, and then suddenly there's a bounce that catches everyone leaning the wrong way. It feels unstable because it is unstable, but not without purpose. It's part of the process of forcing compromise. Now, I can't sit here and guarantee the exact day or hour this thing lands, but what I can tell you is that the pattern unfolding is exactly what you'd expect during a high-pressure negotiation cycle. At this point, I'm leaning toward a later resolution rather than an immediate one, possibly stretching further than some initially hoped, but that doesn't mean momentum is gone. The key isn't the ceremonial moment when a pen hits paper. It's the confirmation that both sides are moving toward alignment. Once that trajectory becomes undeniable, markets begin pricing it in before the signature ever happens. I'm also not suggesting this can drag indefinitely. There are limits. The system doesn't tolerate prolonged uncertainty. At this level, I've heard two separate reports today from different channels. Interestingly, the core details line up in many areas, which gives some confidence that the information isn't random noise. Independent confirmation matters. When separate sources echo similar timelines and sticking points, that tells you the framework is real. However, there was one divergence in their conclusions, and that's where things get nuanced. The date that keeps surfacing is March 1st. That's the marker that was initially floated as a target for resolving the most contentious piece, specifically around Section 404. That's where compromise was supposed to crystallize. But target dates in negotiations are often pressure tools rather than hard deadlines. They create urgency, they signal intent. Whether that date holds or shifts slightly, the broader takeaway is that discussions are active, structured, and very much alive. The yield curve issue is something I've been hearing more and more about, and then you've got the rumors layered on top of that. What about the fines? What about this idea that platforms, especially stablecoin issuers, could be hit with $500,000 per day if they try to offer yield interest or even some creative workaround that smells like interest? That kind of language alone is enough to shake confidence, and that's exactly what it's doing. The idea being floated is that if you slam the door shut hard enough, if you threaten massive penalties, then you guarantee compliance with what this bill was originally intended to do. But here's the thing, none of that is written in stone yet. None of that is voted on. None of that is finalized language. We're reacting to whispers, to negotiation tactics, to positioning. And that's why the markets feel unstable, because they're reacting to hypotheticals, not law. At the same time, I've been hearing from people on both sides of the aisle. Some of my Democrat contacts have told me directly that community banks are flooding them with concern. They're scared. They're saying this could hurt us, this could undercut us, this could shift deposits away. And when community banks get nervous, they lean on groups like the American Bankers Association, which has real lobbying power in Washington. Money flows, pressure builds. Meanwhile, on the Republican side, the message is push forward, get it done. This industry has existed for over a decade without catastrophic fallout. Why are we panicking now? And I find myself right in the middle, not caring about party lines, just wanting clarity for crypto. But the political reality is clear. There are discussions about loading the bill with amendments, adding studies, inserting poison pills that stall momentum without outright killing it. If it never reaches the floor, no one has to take public blame. And that's the strategy I was told about weeks ago, and it looks like it's playing out. Moderates are hesitating, asking for impact studies on community banks. And if you demand a study, you can drag something out for months. So here we are. One side saying slow down, the other saying move now, and crypto caught in the middle. That's the tension. That's the volatility. Now, here's where it gets interesting and honestly a little frustrating. I was told two different things today about the March 1st deadline. One person told me flat out it's a hard deadline, no wiggle room. They need an agreement by March 1st, period. That Sunday is go time. The White House wants clarity. They want to know whether Section 404 is locked in or not. Then I spoke to someone else who echoed almost everything else I had heard over the past few weeks. Same framework, same sticking points, same political pressure, but they said it's a soft deadline. That what really needs to happen by March 1st is a signal. They need to tell the White House we are hours away, maybe a day or two away, and if they need a small extension, they can get it. So, which is it, hard line or soft line? That uncertainty is what's feeding the volatility. Because if it's hard and they miss it, markets interpret that as failure. If it's soft, then the drama could be part of the negotiation theater. And that's what this feels like, theater, high stakes theater with real money on the line. I'm expecting something dramatic, a leak, a negative headline, something that looks like it kills the bill, and then within 24 hours, an agreement framework appears. That's how brinkmanship works. You create maximum pressure right before resolution, and traders are getting whipped around in the process. That's why I keep saying be prepared for both directions. We could see a sharp flush and then an explosive move up if clarity hits, or we could see extended pressure if it drags. But the pattern so far is following the script of intense negotiation cycles, and that's why I'm watching March 1st so closely, not as a magical date, but as a pressure point. Pressure. Let's talk about the charts because the technical side is lining up with the political chaos. We had that massive sell off, and I told you the level I was watching was 1.36. I said if we confirm below 1.36, it gets ugly. Support gives way, and we're likely retesting lower zones, possibly around 120. And what did we do? We dipped into the low 130s, even touched around 131, and then bounced right back toward 136. That's not random. That's a market reacting to news pressure, but not fully committing to breakdown. The 5-day moving average right now is around 1.38. To feel comfortable, to feel like we've regained short term strength, we need to close above that. When we did that before, we ran. We ran hard. Then we cooled off. Now we're back testing major support again. This is the zone I expected us to chop in until we get resolution on the bill. If the Clarity Act passes, XRP does extremely well. If it fails outright, I believe we revisit the sub-dollar zone, possibly 90 cents to 1.15. That's the risk. Add in tariff concerns and broader macro pressure, and you've got a cocktail for volatility. But I'm not surprised by any of this. Negotiation week was always going to be messy. People expected a Sunday night or Monday announcement about a markup vote. Instead, we got tension. That's classic pre-deal behavior. So while it feels chaotic, structurally it's still within expectations. Now let's shift to the tariff refund discussion because this ties into market expectations more than people realize. When the Supreme Court ruled certain tariff structures unlawful, there was immediate chatter about refund checks. I told you then not to count on it. Historically, when tariffs are overturned, the businesses that paid them sue for recovery, and most of the time they win. That money doesn't flow back to consumers automatically. It flows back to corporations, and those corporations already passed much of the cost on to consumers while maintaining profit margins. That's just how businesses operate. They protect margins. So now you've got around $175 billion potentially at stake. And the reality is that precedent suggests companies could reclaim that money. That means consumers who absorbed higher prices don't necessarily see a direct refund. Politically, though, the idea of issuing checks before an election is powerful. We've seen stimulus checks drive sentiment before. And whenever large sums of money hit consumer accounts, a portion flows directly into crypto. I've studied the data. It happens. So if any kind of stimulus or tariff refund check emerges before November, crypto could see a significant inflow. That's not a guarantee, but historically, liquidity injections create speculative waves. And that's why I'm watching this angle closely, not because I rely on it, but because if it materializes, it's a catalyst. Looking back at the Clarity Act probability swings, it's almost textbook. We moved into the mid 30% range, then climbed into the 50s as optimism built. Then another leak drops, and we're back down into the mid 40s. That's the volatility I warned about. Both the banking lobby and crypto industry are pushing hard. I've heard they are closer to agreement than they were weeks ago, but not there yet. And why rush when you've got until March 1st? They'll squeeze every concession possible before that deadline. That's negotiation. If this resolves soon, we could see a massive short squeeze. If it drags, downward pressure likely continues. My overall probability still sits above 50% that it gets done by late spring. The risks are external distractions, government funding fights, geopolitical tensions, other legislative priorities. Crypto isn't always top of the list, but too much has been invested in this process to walk away empty handed. That's why I still lean cautiously optimistic, even while acknowledging political dysfunction is real. At the end of the day, we're at what feels like the 99-yard line. 1 yard away from regulatory clarity that could position the United States as a leader in crypto framework and innovation. If it crosses the line, you'll see capital and companies flood in. If it fails, other jurisdictions like the EU or the UAE will gladly absorb that innovation. Crypto businesses move where rules are clear. They don't thrive in uncertainty. That's the core issue. So, yes, there's risk. Yes, there's volatility. Yes, politics could derail it, but the amount of time, money, and political capital invested suggests no one wants to walk away empty handed. So, prepare for both outcomes, manage risk, stay informed, and understand that in high stakes negotiations, the loudest week is often the one right before resolution.